welcome to another episode of our earnings season coverage. We are doing some catch up here and reviewing some earnings we received a few weeks ago. Of course, we got busy with the whole GameStop fiasco and other events, and I kept the earnings review in the back burner, but here we go. Back in the saddle again. And the goal from doing all of these earnings reviews is to assess companies based on the fundamentals and their earnings, in addition to finding opportunities in certain stocks to invest in if they deliver good results and the stock is pricing at a reasonable valuation. We also use the earnings reviews to assess whether we should take profits in some of our positions if the earnings reports come disappointing or show slowdown in momentum, specifically in stocks that are already trading at very rich valuations. With that being said, here is the list of companies that reported during the second week of this earnings season. I did publish an earnings preview video for all of these companies. I'll leave a link in the description because we go over each company in details and what we were expecting from their earnings reports. In this video, however, we will do the reviews only for certain companies, depending on the impact of their earnings on the overall market and whether we can find a buy or sell opportunities. And here are the names that I'm going to review in details: Lockheed Martin, 3M, American Express, Starbucks, Microsoft, in addition to AMD, Tesla, Facebook, Apple, Northrop Grumman, Visa, Southwest, and Caterpillar. And here we go, starting with Lockheed Martin earnings report. And as I explained to you in the earnings preview video, I was going to assess Lockheed Martin's earnings versus Northrop Grumman earnings and figure out which is the best name to buy in the defense sector. And here are the key metrics that I'm judging these two companies based upon. Number one, the year-over-year revenue growth for the fourth quarter. Number two, the year-over-year revenue growth for the entire year. And then we will do the net income growth year-over-year. And this is, of course, for the entire year, not just for the fourth quarter. And then I'm looking at the year-over-year growth for each business unit in these two companies. Lastly, we will look at some valuation metrics, specifically the price to earnings and the price to sales ratios for both companies to figure out which stock offers the best deal at this point. And here we go. The year-over-year growth for the revenue in the fourth quarter for Lockheed Martin came out at 7% versus 17% for Northrop Grumman. What about the year-over-year revenue growth for the entire year? Lockheed Martin 9%, Northrop Grumman at 9% as well. Moving on to the net income growth year-over-year, Lockheed Martin 9.6%, Northrop Grumman down 26%. So massive contrast here between these two companies. One managed to be profitable for the year, the other one managed to lose over 26% year over year. And what about the growth for the aeronautics business unit? Lockheed Martin 11%, Northrop 9%. Meanwhile, the hottest segment in the defense industry right now is the space segment. So how did both companies do in terms of growth year over year for the space business unit? Lockheed Martin 9%, Northrop 18%, doubling the growth rate of Lockheed Martin. What about the defense business unit? Year over year growth for Lockheed Martin at 11%, meanwhile only 1% for Northrop. And what about the mission business unit year over year? The growth for Lockheed Martin came at 6% versus 7% for Northrop. And lastly, the price to earnings ratio for Lockheed Martin at 14 versus about 16 for Northrop. And the price to sales ratio almost identical. Lockheed Martin at 1.47 versus Northrop at 1.39. Now, if you're judging both companies based on the hottest segment, which is the space segment, you will go with Northrop Grumman because they have grown their space business unit by double digits and double the rate of growth of Lockheed Martin. However, I'm looking at a wholesome approach here, and when you look at the revenue growth, the net income growth, and the overall growth for each business unit, in addition to the valuation metrics, Lockheed Martin also pays more dividend than Northrop, and because of that, the wholesome approach of reviewing both companies, I choose Lockheed Martin. Yet I am very hesitant to open positions in any of these companies, not because the common reason that the Joe Biden administration, the Democrats, will cut defense spending. That has always been said regarding any incoming Democratic administration. Yet Democrats almost always increase defense spending, perhaps not as the magnitude as a Republican administration would, but cutting defense spending is usually not of concern. The concern here is that the Joe Biden administration will halt arms sales to certain foreign countries, and that could hurt the bottom line for the entire defense industry. Next, we have 3M. In our discussion in the earnings preview video, we were looking at a wounded company for 3M. We were looking for turning the corner, seeing the light at the end of the tunnel. If there are any indication that this company is turning the corner, I would open a position in 3M, and indeed I did buy the stock after this report. And here are the reasons. Number one, their net sales grew 5.8% year over year, and the net income grew 22.4% year over year. So Triple M is turning the corner and becoming a growing company once again, in addition to better cost management and favorable exchange rates, because the US dollar declined in value in the fourth quarter, and that indeed helped Triple M's earnings. Furthermore, the free cash flow grew 16% year over year in the fourth quarter and 18% year over year. That is the annual rate. And here are the performances for each segment of the business. We know that safety and industrial, healthcare, and consumer were growing modestly year over year during the third quarter. The problem was in the transportation and electronics business unit. In the fourth quarter, we finally saw positive growth year over year for the transportation and electronics business segment. In addition, other business segments maintained the rate of growth. And that was the indication right there that Triple M is turning the corner. And we are seeing the light at the end of the tunnel, and the worst is behind for this particular company. They have almost doubled the growth rate for the safety and industrial business segment. They have recovered positive growth for the transportation and electronics business segment. Meanwhile, maintain the growth in the healthcare and consumer business units. Now, what about the technicals? Let's go back to the earnings preview video and revisit what I said about 3M's chart. And what about the chart of Triple M? We see a descending trend line acting as resistance all the way back since the top in 2018. We are seeing a reverse head and shoulder formation in the chart, and we have already broken that descending resistance line. We have checked it for support. The chart looks technically very, very healthy. And if the numbers meet expectations and we see improvement in the transportation and electrical segment, this name could rally significantly higher, and we will see market participants appreciating this name a little more. It's a dividend-paying name, and perhaps the worst is behind for Triple M. And indeed, we saw a positive reaction after earnings, and we saw a mini breakout. The chart looks very healthy here. We saw a reverse head and shoulder formation, leading us higher to break the descending line of resistance, and I do see more gains for this stock in the future. Next, we have American Express, and let's see what happened here. The revenues for Amex declined 18% year over year for the fourth quarter. Meanwhile, the net income declined 15% year over year during the fourth quarter, and the annual growth rate or lack thereof in net income for American Express was down 54%. Massive damage for this company. Meanwhile, the stock is trading pretty much closer to the pre-pandemic highs. It doesn't make any sense at all. I used to own the stock last year when we played the rotation trade, but that was just a trade, not an investment. I wouldn't buy the stock again until we see a correction in the stock price and earnings improving in the next report. But the beauty of reviewing earnings for a company like American Express is it gives you a pulse on the health of other industries. For example, the T&E spending in the fourth quarter for restaurants was down 39% year over year, down 68% for lodging, 85% for airlines, and check this one out, 98% for cruises. So Amex did recover some spending on all of these activities since the second quarter of last year during the height of the coronavirus crisis. But we are far away from making full recovery. Not even close. This company is not out of the woods yet. Not even close. And given where the stock is trading right now, I will stay away from this name. Moving on to Starbucks. What do we see here in the earnings report for this company? The Americas segment, the revenues were down 6% year over year. Meanwhile, the income was down 26% year over year. These are not good results at all. The company is still contracting in the Americas segment. What about the international segment? The revenue growth year over year came at 5%, a little better than the Americas segment. Meanwhile, the operating income was flat year over year. And let's revisit what I said about this particular chart of Starbucks during the earnings preview video. Now, let's visit the chart of Starbucks. While the company suffered lack of financial growth last year, magically the stock managed to do very well and it made all-time highs. So what do I see here? I see head and shoulder formation. I see weakness. The MACD indicator is about to cross and create red impressions in the histogram. We are seeing a loss of momentum from the RSI from a weekly perspective. I say regardless of how good the earnings report might be, we will trend lower after earnings, going all the way back to revisit the 20 weeks moving average. And indeed, the stock went down to revisit the 20 weeks moving average, but rebounded right away and recovered all the losses right after the earnings report. Now, the stock is trading pretty much at all-time highs, but the results do not support where the stock is trading. And therefore, I would stay away from buying Starbucks at this point. Next, we have Microsoft. The top line for this company grew 17% year over year. Meanwhile, the bottom line grew 33% year over year. This is for the fourth quarter, and we're not talking about a small company here. We're talking about a behemoth, a giant like Microsoft, experiencing 17% growth on the top line and 33% on the bottom line year over year. Very impressive results. But the most important segments we're watching here are the Azure and Xbox segments. So let's see how those perform. The Azure business grew 50% year over year, and the Xbox business grew 40% year over year. Impressive results here for Microsoft. Very clean report. The problem, of course, is while Microsoft grew the top line by 17% year over year and the bottom line by 33% year over year, the stock has moved over 50% year over year. And this is a classic problem that we run into during earnings seasons. Sometimes we get a decent report, excellent performance. However, the stock is already pricing the story and then some. It is very hard to beat the expectations of what the stock is pricing at these elevated levels. And to illustrate that, let's move on to AMD, because if you thought that Microsoft's report is impressive, wait till you see AMD's. The revenue growth year over year, and this is for the entire year, was up 45%. Meanwhile, the net income was up 630%. Unbelievable numbers. And of course, there is a reason why the net income jumped significantly. There are taxation reasons, but regardless, the growth for this company remains intact and building more and more momentum each quarter. Why is that? Because they're taking business away from Intel and Nvidia. And here are the results for the fourth quarter. The growth year over year for the top line came at 53%, and for the bottom line, the growth was at 948% year over year. Once again, there are reasons why the number is so elevated, taxation reasons, but regardless, this is an outstanding report, and it is no different than the previous report we have received from this company. And what about the business segments growth? For the computing and graphics, for the fourth quarter, business was up 18%. For enterprise, business was up 176%. Once again, massive growth, impressive growth for AMD. So the question is, why haven't the stock reacted more favorably after receiving this very impressive report? Remember, the company grew the top line for the entire year by 45%. Meanwhile, the stock grew over 100% for the same period. Once again, it is very hard for the stock to move higher once you've already moved 100% year over year. Meanwhile, the top line business growth was at about 50%. So if you've already priced that and then some, that makes it very hard for the stock to move higher based on these results because the valuation has become more stretched. But make no mistake, any correction here in AMD to the tune of 15% or more, and I will be a buyer of this name. Next, we have Tesla. Right away, we see that the automotive revenues were up 46% year over year. Very impressive growth for the automotive manufacturer. But here's the problem with Tesla. Pay attention where it says of which regulatory credits. In the fourth quarter, it was $401 million. Now, let's move a little lower and take a look at the net income. And we're talking about the GAAP net income, the one that you cannot manipulate. It came out at $270 million for the fourth quarter. If you take away the $400 million of regulatory credit that Tesla received during the fourth quarter, the company would have been not profitable. This is the criticism that a lot of Tesla watchers have been outlaying for multiple quarters now. This is a company that is not profitable from their core business, selling cars, but they are profitable due to the regulatory credits. Now, what happens once other manufacturers, such as General Motors, Ford, and the likes, start to produce their own EVs and they no longer need regulatory credits? What happens to Tesla's bottom line then? In addition, the competition will pressure margins, so the trajectory here for the bottom line for Tesla is lower, and that is the problem with this company, specifically given where the stock is trading right now. Another thing I want you to pay attention to is the free cash flow. For the fourth quarter, the growth was 84% year over year, and that is a very, very impressive growth for Tesla. The whole bear argument a few years ago was that Tesla's about to go bankrupt because they will run out of cash. Fast forward a few years later, and having enough cash is not a problem whatsoever for Tesla. They have used the retail investors' enthusiasm in buying this stock very wisely by issuing more shares and raising more cash. And right now, Tesla has about $19.5 billion in free cash. And of course, that emboldens CEO Elon Musk to gamble with about $1.5 billion in Bitcoin, because why not when you have this massive amount of cash in your books? In my opinion, the move is still reckless, but when you look at these numbers, you don't have to wonder why Tesla shareholders did not hold Elon Musk's feet to the fire. The reason is the company has plenty of cash. And what about the growth via vehicles segment? And of course, here's the problem with Tesla and why a lot of people accuse it of accounting fraud. Number one, they lump each model with each other without giving us an individual number for each model. Number two, the company never provides the sales broken down by geographic regions. For example, take a company like Ford or General Motors. They always provide the sales by region, and analysts can access the public registration records for each region and verify the numbers. Tesla never produced that kind of numbers, so we never know whether the numbers are correct or not, and we never know where are the regions of growth and contraction. We'll never know because Tesla never released those numbers, and we just have to take their word for it. Nonetheless, the Model S and X production was down 10% year over year for the fourth quarter, so this particular segment is declining in growth. However, the Model 3 and Model Y segment grew over 88% year over year. Once again, very, very impressive growth. However, wouldn't it have been nicer if they just gave us the individual numbers for the Model 3 and Model Y separately, so we can judge each model based on their own individual numbers? I hope that Tesla will do that in the future by providing the sales by each geographic region and breaking down the sales per model, individual model not just lumping two models together. Also in the report, they provided us with an update to the new Model S redesign. And I don't know if you see the problem that I'm seeing. How the hell will you be able to do a U-turn with this steering wheel? I have no clue. And they also provided us with an update for the Berlin Gigafactory, and it looks like it is very ready to be completed. And the only issue here is that they had to chop a massive area of the surrounding forest to build this factory. Yet according to Tesla fans, destroying the forest is just another necessary step to save the planet. And here is another update that Tesla provided us with. The Texas Gigafactory. 3 months ago, it was pretty much an empty piece of land. And now the construction has advanced tremendously. They're getting very, very close to finishing the project. And this is, of course, for the production of the Cybertruck. And the moral of the story here, take a look at this picture. And this is the magic of private business. In 3 months, they have turned that empty land and they've already built something, and they're getting very, very close to finishing the project already. Can you imagine if this was a government project? The picture for the present day will look exactly as it looked 3 months ago. Matter of fact, the picture 3 years from now will look exactly as the picture from 3 months ago. Government cannot do any of that progress in this time frame. Tesla, on the other hand, a private business, in 3 months, they can accomplish what you're seeing on the screen right now. And moving on to the big kahuna, Apple. And of course, we had our concerns in the earnings preview video, specifically given the fact that the net income for Apple did not grow during the last quarter. Matter of fact, it contracted. Furthermore, we saw a tame number for the sales in Greater China. So let's see how the fourth quarter ended up being, specifically given the release of the new iPhone 12. The total revenue exceeded $111 billion compared to about $92 billion a year ago. That amounts to a growth rate of 21% year over year for the top line. What about the bottom line? Apple pocketed about $28.7 billion in the fourth quarter compared to $22.2 billion in the prior year. And that amounts to a growth rate of 29% year over year for the bottom line. And another thing to point out here for all of you corporate defenders out there who are defending the rights of corporations and how we should just let them roam free, and any increase in the minimum wage is horrific for the rights and the well-being of these big corporations. Here's something for you. Apple has a provision of income taxes of about $4.8 billion. That is on an income of about $33.5 billion, which amounts to an effective tax rate of 14%. Ask yourself once again, are you paying more or less than 15% in taxes? Why does Apple get to pay less than the individual taxpayer? But back to the earnings report, let's check out on the regional performance for Apple during the fourth quarter. The concern was Greater China, and I said during the earnings preview video, are we seeing a negative sentiment for the Chinese consumer regarding American products in general, and specifically for Apple, because the number was disastrous during the previous earnings report? Or is the Chinese consumer just waiting for the new batch of products from Apple to start spending? And the latter case was correct, because the sales in Greater China increased significantly year over year. During last year, Apple made $13.5 billion during the fourth quarter in 2019. Fast forward to the fourth quarter in 2020, Apple made about $21.3 billion from the Greater China region. Apple also managed to grow in every single region, whether we're talking about the Americas, Europe, Japan, Asia Pacific, all experienced growth year over year during the fourth quarter. What about the net sales by category? The segment to watch here was the iPhone business unit, and the sales came impressively as expected prior to the report, yet we saw growth and momentum continuing for both the Mac and iPad business units. Wearables, services also growing year over year. All in all, This was a very decent report by Apple. They have beaten expectations, delivered in every single metric, and pretty much there is no disappointment to be found in this report. It was a clean, excellent report by Apple for the fourth quarter. So why didn't the stock react more favorably to this report? Why did the stock drop about 10% from the highs after this report? The reason is, as impressive as these results are, the stock is already pricing the story and then some. It's already trading at extreme valuations, never been seen in Apple's trading history. So no matter how good the results are, it's very hard to satisfy where the stock is trading right now. Matter of fact, when you take a look at the chart, keep in mind that Apple grew 21% on the top line and 29% on the bottom line year over year during the fourth quarter. Take a look at the growth for the stock year over year since the end of the fourth quarter in 2019. The stock almost doubled in value. Meanwhile, the growth generated for the company during that period was only a fraction of this number. We will talk about Apple a little more right after we cover Facebook's earnings. And there is a point to illustrate here. Which company is the better buy, Apple or Facebook from a valuation perspective? Let's take a look at Facebook. The revenue growth year over year for the fourth quarter was about 22%. Meanwhile, the year-over-year change, we're talking about the annual rate of growth for the top line for Facebook, grew 33%, much better than Apple. Furthermore, the net income grew 58% year-over-year during the fourth quarter and 53% year-over-year for the entire period. These numbers are much better than Apple. Furthermore, another point to illustrate here, take a look at the effective tax rate for Facebook. For the year 2020, the effective tax rate was 14%, so it is a similar rate to Apple's effective tax rate. Once again, ask yourself a question. Are these big corporations who are making insane profits paying their fair share when an individual taxpayer is paying about 50% in taxes? Just something to think about. Now, let's look at the valuation metrics for both Apple and Facebook and try to figure out which company offers the better valuation. We know from the fourth quarter results that Facebook beats Apple on both the top and bottom lines in terms of growth. But how do the companies stack against each other from a valuation perspective? Starting with the PE ratio, Apple at 36 versus Facebook at 26.8. Facebook is better valued than Apple. But I don't like to look at the PE ratio per se because it is a lagging metric of valuations. So I like to look at the forward PE ratios. And in this case, Apple at 28.9 versus Facebook at 20. Facebook is the better valued company. What about the price by sales? Apple at 7.7. Meanwhile, Facebook at about 9, meaning that Apple offers better valuations from a price to sales perspective. What about the price to book perspective? Apple at a staggering 34.6 versus Facebook at 6. Apple is way more overvalued than Facebook if we're talking about the price to book ratio only. What about the PEG ratio? This valuation metric factors in growth, not just PE ratio, but also factoring the growth of the company. The lower the number, the better the valuation. In this case, Apple at 2.49 versus Facebook at 1.25. Facebook offers the better valuation here. And lastly, let's take a look at the EPS growth for the last 5 years, and whether these rich valuations are warranted or not. Apple grew only 7.3%. Meanwhile, Facebook grew 50.8%. Granted, Facebook is a much younger company than Apple, but when you combine all the information, the better buy here is Facebook. It offers higher growth, it is cheaper in valuations. The problem is here is the regulatory risk against Facebook. Similarly, there is a regulatory risk against Apple as well. But if I must choose between Apple or Facebook to deploy capital right now, I would choose Facebook without any hesitation. Moving on to Visa. Let's see what's going on here. We talked about American Express. Let's see how Visa did. The net revenue down 6% year over year. Meanwhile, the bottom line, or net income, is down 4% year over year. And here are more insights from the earnings report. As you can see, the credit card volume has been lagging since the beginning of the pandemic crisis and has not recovered at all. Matter of fact, it is trending lower during the fourth quarter, while we saw debit card spending recovering and trending higher. What does that tell you? It tells you that the consumer is being very cautious and conservative here by not using their credit cards. The consumer is worried about racking more debt on their credit card, and they would much rather spend from what they have on their debit cards instead, and not overspend on things they don't need and cannot afford. Furthermore, the majority of the spending is also taking place by the stimulus checks, offsetting the need of using credit cards. This remains a sticky point, not just for Visa, but also for big banks. Consumers are being very cautious about racking more debt during this crisis by using their credit cards. And of course, when we talk about inflation and expectations of the reopening of the economy post deploying the vaccines, you cannot help but to wonder whether consumers will feel more secure and more confident, and they will deploy not only the stimulus saved in their accounts, but also resuming using credit cards. And that would add tremendous upward pressure for inflation. And lastly, let's visit the chart of Visa. We talked about the top and bottom lines down significantly during the fourth quarter and down significantly for the entire year. So why is the stock trading at almost pre-pandemic highs? It doesn't make sense at all. Visa is not out of the woods yet. Yet this is just another illustration of the current mania in the stock market and the ETFization effect in the market. Visa is lumped in with other big tech names. They get bought when investors buy the ETFs and thus pushing the price higher, even though the fundamentals of the company do not support where the stock is trading. Moving on to Southwest, and of course we will continue our discussion in evaluating airlines earnings via specific key metrics. And since we have received the report from Southwest and American Airlines, we will combine that information with the previous earnings we received from both Delta and United to figure out the best airlines operator stock to buy, and we will let the numbers speak for us. I'm not concerned about revenue or income, bookings, revenue per mile, seats. I'm not concerned with any of these typical classic airlines valuation metrics. Why is that? We know that the entire industry is in trouble. We are assessing and evaluating these companies based on their financial health to withstand the crisis. We're looking for the best company from the financial health perspective. We're not worried about revenue, expenses, net income, etc. We're not worried about any of these. We are worried about the cash burn rate. This is the daily cash burn, and then the short-term maturities of the debt obligations for these particular companies. Lastly, we're looking at the cash on hand. Knowing these numbers will help us to find out the best airlines operator and the name that will manage to recover and thrive faster. The cash burn rate for Southwest Airlines came out at $12 million per day. Meanwhile, the short-term maturities for Southwest at $526 million and the cash on hand at $11 billion. What about American Airlines? The cash burn is at $30 million per day, and the short-term maturities at $4.4 billion. Meanwhile, the cash in hand is about $3.3 million. Right away, it does not take a genius to figure out that the best name to buy in the airline sector, the healthiest company from a financial perspective, is Southwest, followed by Delta, followed by United, and then last and least, American Airlines, the weakest name to invest in. Recently, they managed to raise over $1 billion from the retail mania during the Reddit pump, and that is all good for American Airlines, but they are far away from the light at the end of the tunnel, and it is threatened of falling apart financially if the crisis continues and we don't receive another bailout for these airline companies. But assuming that the recovery and the vaccination efforts turn out to be successful and we normalize the economy and passenger traveling, it will take a long time before American Airlines recover their financial health. Therefore, if you must buy an airliner, Southwest is the name to buy. And lastly, let's take a look at the earnings for Caterpillar. This is a name that often touted as one of the most favorable names to buy due to the Biden administration's plan of infrastructure spending and due to the rise of inflation and the decline of the US dollar. So let's see how they did during the fourth quarter. The sales and revenues were down 15% year over year, and the profit was down 28% year over year. These are horrible numbers, and it shows that Caterpillar is still struggling and is not out of the woods at all. Meanwhile, when you take a look at the chart of Caterpillar, the stock has grown over 38% for the same period. Doesn't make sense at all. This stock has been rising based on the momentum and the psychology alone. The numbers do not support where the stock is trading. Everybody's buying Caterpillar under the assumption that infrastructure spending will recover all the losses from 2020 and then some. But you have to remember that for every incoming administration, infrastructure spending was touted as a possibility, and a lot of analysts recommended buying Caterpillar, and we never saw infrastructure spending whatsoever. They said the same thing about the Donald Trump administration, and we never saw any infrastructure spending. Now, we might see it during the Biden administration, specifically if we see a trajectory of higher interest rates. They would rather do the spending now, capturing the low interest rates versus waiting till these interest rates rise higher. So we could indeed see infrastructure spending, and that would be very good for Caterpillar. But for now, looking at these numbers, they're abysmal, and looking at where the stock is trading, there's no way you'll convince me to buy the stock at this level. I would wait for a big correction and then reassess. And of course, I'm waiting for the results from John Deere. We are supposed to receive those during this week. I will pin Caterpillar results with John Deere's results, and we will do the valuation, metrics, the ratios, and figure out the best name to buy here. Caterpillar versus John Deere. For now, this is a wrap-up for the earnings reviews for that particular week. I do have more videos coming up for you, reviewing more earnings that we saw during last week and the prior week. But for now, I hope this video was helpful to you, and if it was, return the favor by pressing the like button, subscribing, and leaving a comment. Thank you for watching.